Kevin, I thought you had a pretty spicy take yesterday, though
Did I?
I am from Wisconsin, and so Wisconsin,
Midwest spicy.
Minnesota. Yeah, on reinventing primary care. So Carbon Health
hmm
filed for bankruptcy this week. Can you refresh our collective memories on the Carbon Health story?
Yeah, I mean, it was a version of primary care reinvention from a previous era, right? COVID times, it was flying super high. It was talking about how their CEO was out there talking about how he was going to build I think it was the greatest modern healthcare company. Whole bunch of clinics across the US. I forget the exact number. I think I put it in the newsletter. Was it 1,500 clinics by 2025? Yeah, 1,500 clinics by 2025. So, I mean, charting a lot of growth. At the time, I think Carbon had a couple like interesting iterations of we're going to be tech platform and then we're going to acquire some practices and then they tried being tech platform again and that was kind of some of the change over time for the organization. But as it was growing really fast, what it was ultimately doing was going and buying up onesie twosie urgent care chains. At a time when the market was particularly frothy, and then they were trying to turn those urgent care clinics into more than urgent care, right? Primary care, reinvented front door experience, some value-based care elements to it. They were acquiring different chronic condition management companies, so on and so forth, and trying to build what I think any of us, like if we were sketching out on a piece of paper what a front door access point to healthcare might look like pretty reasonable thing. Of course, the challenge with healthcare, as we talk a lot about on this, is that pretty reasonable things don't actually always make money in the healthcare environment because healthcare is a unique market. And it started to struggle as soon as we got out of COVID. COVID testing revenue, I'm sure, went down. They started losing money. And market forces being what they are, it really struggled. It raised what, 100 million bucks from CVS back in 2023 at a billion plus valuation. So CVS was actually one of the largest equity holders in Carbon when it ultimately filed for bankruptcy. At that time, Carbon was pivoting back to being like tech software platform, enable CVS clinic offering, so on and so forth, which again, kind of logical narrative. But to me, it's one of those hard lessons to learn along the way of the entrepreneurial journey, right? Like I was in primary care startup that failed too. You raise a lot of money and then all of a sudden you realize that the economics are a law of gravity and it's hard to make money in primary care clinics when you're growing like that. And I mean, this is where I think maybe slightly spicy, but I also think if you go back and read their CEO at the time, he made a few comments along the same lines of, listen, we're losing a bunch of money. We got to get to be the scaled primary care entity to change the unit economics of the industry in order to get this thing to profitability. Which, like, I I I I don't disagree with that statement. I don't know if it would have played out effectively, but I mean, this is it. They didn't get to scale, and it didn't work out, and that's unfortunate. And it's kind of how things go, right? Did you have any other different takes from the Carbon bankruptcy?
No, I think the thing that I thought was spicy was the like, is AI going to solve our problems? Because it
Yeah.
feels like right now the general vibe, the general narrative is, well, AI is going to sweep in this era of abundance. And you had kind of a funny story about signing up for an AI doctor.
Yeah. So, the big funding round last week was Lotus Health, right? They raised 36. They announced 41 in total, but I think it was across two rounds and one was previous. From big name investors, right? Kleiner, CRV, which are two highly regarded investors in the space. And they put together some really nice hype videos around how Lotus is gonna 10x the capabilities of primary care docs, fundamentally allowing us for us to scale access to free primary care in this country, which is like an amazing vision, right? Cool. If we could do that, that's awesome. We should definitely do that. Then, so, I got intrigued by their model. They announced it on Tuesday. Wednesday night, I went to sign up for the app, and the app's like, you're in wait only mode. I posted this on LinkedIn. And it says I'm in wait only mode because the providers that the app partners with are busy and have no capacity to take on new patients. And it's like, okay, that makes sense. I'm sure they're partnered with some other startup that's got a handful of docs with it, and I'm sure they got a ton of attention from going on LinkedIn and Twitter and all the places with this, hey, it's free primary care for everybody. And it's like, what's actually going on here? Um, it seems much more like telehealth model where they're accessing a group of docs. And then it's also funny to me, I didn't put this in the newsletter or in the LinkedIn post, but if you're reinventing access to primary care and your thesis is that you're going to 10x primary care docs, I would think that a core part of your team should be having a handful of good primary care docs who you are 10xing. Like, I want to build you primary care doc technology to allow you to scale what you do like uniquely really good. So I went on their career page, and you want to guess how many jobs they have posted on their career page, Martin? Less than five, 5 to 10, 10 to 20.
I'm gonna guess 5 to 10.
Less than five. You want to guess how many of those are clinical in nature?
Two.
Zero. It is three engineers that they had jobs posted for. And I'm like, you can see what's happening behind the scenes, right? Group of technologists coming in, raising a bunch of money, saying, "Hey, we're building this new technology. We're gonna partner with Wheel or whomever it is to give us telehealth access into docs, and they're gonna do the um, prescribing things that they need to do that we can't do from a technology perspective." And off we go. Like, great. But I think when you step back and think about it, and this gets back to the newsletter musing, like the rate limiting factor in my mind, it's not the technology. It's the trust of good primary care docs in this country to scale them up 10x when like they're overburdened, they're overworked, they're unhappy, they're talking about unionizing in places like Boston where all of these things are true. And it's like if you go to one of those primary care docs and say, "Hey, I'm gonna 10x the amount of work that you have right now, so you can go from 2,000 patients to 20,000 patients," like who who's gonna be like, "Oh yeah, sign me up for that, Martin. I want to go do that now." I
Well,
don't
one of our favorite conversation topics here is about direct primary care, which
know.
involves going and doing the opposite of
For sure.
taking your 2,000 person panel and bringing it down to, I think the average is 400.
Yeah.
And if you are the best of the best primary care doctor, if you're, I saw the same pediatrician from when I was literally born to when I was 18. There's like no amount of money that I wouldn't pay, to have like,
Mhm.
I was like sitting there as an undergrad being like, hey, it's me. And eventually, after I graduated from college, she kicked me out. But yeah, like I would have paid for her to be my direct primary care provider. Uh,
Yeah.
that's like, it doesn't really seem like if you have the choice that that particular doctor would want to go and have 20,000 patients.
No, I don't think so, unless they get paid really well for having those 20,000 patients. But then you get as you meant, like, how are you gonna have relationships with that many people to deliver that style of care? I don't know. And this is it's where I lose the plot a little bit, and it's to me a shame because it's like it reminds me a little bit of the narrative with virtual primary care back in like 2018 to 2020 era, which was you had this crop of startups who were like, we're doing primary care virtually. We're going to do it through an app. You're going to have access to your doc. It's going to be high quality primary care. And then you had a whole bunch of other telehealth companies saying, we're doing virtual primary care too. But what it actually was just virtual urgent care visit. Like when you have a need, they solve that need, very transactional, off you go. The issue when that happens is that when an employer hears a pitch from a virtual primary care startup, they don't actually have the capability to understand what the difference is between the two. So the urgent care model wins because it's cheaper and the data doesn't look all that different because these companies are good at telling the narrative around how their model still works, right? And so the virtual primary care companies are over here being like, well, we're getting squeezed because nobody actually wants to adopt us because they're all just going with these dumb telehealth models. And the whole thing falls apart because it doesn't actually work or change anything at the end of the day. And that, like, I think there is such a clear use case need. Like the article that I mentioned from KFF in Boston, that is wild to me, Martin. There was a woman in Boston whose PCP died. She needed access to blood pressure meds, and so she was looking for a new doc. She called up 10 practices, and the soonest visit she could get, apparently, was a year and a half to 2 years, which, like, I don't know that I actually fully believe, just given how far of a data point that is. Like, that can't reflect reality in Boston. Nonetheless, I think it's what the article said. Um, we need to figure this stuff out. I think AI needs to play a role in augmenting clinicians. This was the conversation we had with Andy and Toyin too in the community, right? Like it it needs to be part of the answer, but I think we need to have a nuanced conversation around what that looks like. And my favorite topic, the iron triangle of trade-offs, right? Like if we want access and we want high quality care at the same time, we're going to need to pay for that. And just like expecting VC-backed startups uh to drive that change societally for us, I think is it's unfair to the startup. It's unfair to set that expectation for anybody. And anyways, I don't know.
And back to the Iron Triangle, another one of our favorite topics is
Mhm.
primary care is already free for everyone with insurance in the United States. The problem is that you have to wait. You might have to wait a year and a half, or you might have to,
Yeah.
pony up for a one medical membership. You have to pay
Mhm.
like the 200 or $400 or whatever to get a one medical membership just so you can see a primary care doctor in a reasonable amount of time. And so
Mhm.
the access is, I would argue, the bigger challenge than price when it comes to primary care. And
Yeah, for sure.
we just don't have enough primary care doctors.
Yep. I am very curious. I was thinking about this over the weekend. I was like, when is there going to be a more Wikipedia style approach to this? Like, give me a not-for-profit that has not raised any venture funding, that just has people donating their time to try to build like what is truly a free database that people can access, ask questions, docs can volunteer their time. And I know there's going to be a whole host of issues with that, but like, I actually think it would be really intriguing to have just a pure not-for-profit version of this model to try to go after it. Because I think that would actually have a better, you would have the, like, if the iron triangle holds, you would probably be more likely to have access and cost be low, which means quality is going to be the issue in that sort of a model, right? Which intuitively makes sense. Not every great doc is going to go into that. And so you're going to have issues with quality of care, which is probably the issue with it. But I'm like, if somebody really wants to go after free primary care access in this country, I think that has to be more the approach in my mind. Otherwise, it's going to be a different outcome.
I actually think this is the perfect segue to hospital margins
Ooh,
because we go from primary care doctors who don't make enough and are overworked, and then we're talking about hospital margins. And so you shared something from the Hoosier State, the home of the college football national championship team, which a phrase that I never thought I would say.
speaking
The
of paying up for things, Martin,
um, but yeah, and Mark Cuban. I mean, this really is bringing in everything that you could want.
everything. Yes,
We got everything. We got Mark Cuban. We've got Indiana.
yes.
But hospitals in Indiana seem to be doing quite well. Well, some of them. And so you talked about that a little bit in the
Yeah.
newsletter this
So
weekend.
Indiana has always seemed like an interesting market for hospital prices, right? It seems to have high costs. It's always kind of a talking point publicly in the state. This again came up. Kaufman Hall shared presentation. I don't know who within the state, but we linked to it in the newsletter. And the presentation talks about how, margins are pressured in the state of Indiana. It's tough being hospital. Kind of the typical talk track I think we hear throughout the country. Um, and they noted that margins were below the national average in 2025 for hospitals. Um, the Employers Forum of Indiana, I don't know who that all represents. I assume a group of employers in Indiana, issued a response to it being like Kaufman Hall. You only looked at data from 53 hospitals in the state. We don't know why you did that. If you look at data from 114 hospitals in the state, which they say is all the hospitals in the state, and you look at the 2024 Medicare cost data to look at profitability, it actually paints a very different picture. You've got 21 of those 114 hospitals that are averaging a net profit margin of 27%. Got 30 of them that are in a category from 10 to 19% range that average 13.2%. And you've got another 31 that are in the 0 to 10% net profit range that average 5.8%. That means that you've got 32 out of the 114 hospitals in the state that are below zero in 2024 from a net profit perspective. Obviously, net profit and operating profit, two different concepts, right? Hospitals generate a lot of money from their investments, which is why net profit is usually higher than operating profit. So I went in and I looked at the data. They've got the information on revenue, operating expense, and then other income expense. And so you can calculate operating margin, right? And some of these hospitals in the state have the one I cited in the newsletter, Parkview Orthopedic Hospital, has a 37% operating margin. I mean, this organization, according to the data that was shared in this report, had 186 million in revenue in 2024 and 117 million in operating expenses. So they made $70 million in operating income in 2024, a 37% margin. Like
That's not bad.
that's really good, right? Like any
Depending
business
on
you're
how they're
running, you're
growing,
like,
they
yeah,
could be a rule of 50 company.
right. They're close to it even without growth, Mark. Like um it, I think, runs counter to the general narrative that you can't make money in these hospitals. But it does match up with a few data points we're hearing elsewhere, right? Which is HCA's call the other week. We hear research analysts saying, "Hey, can you sustain 20% operating margin?" Um, like if you're in the group of hospitals that is doing it right, you're doing really well right now, is my general takeaway from this. And I like we got a bunch of comments back from the newsletter yesterday saying, well, it's an orthopedic hospital. Of course, it's making more money. It's just focused on orthopedic procedures. They're hammering the high profit stuff. And I'm like, yeah, I that certainly plays a role in this. But like, go look at the data. Extensions Hospital in Carmel, Indiana has a 28% profit margin, like operating margin. I'm like, that's still pretty dang good, right? Like, that's still, I would happily take that as a business. And so it's I don't know. We've talked a little bit about kind of the emerging bifurcation of haves and have-nots in health systems. And this like lumping them all together into this health systems hospitals are not performing well. I don't think it's a super helpful narrative for us because it lumps all of that in. So I'd be curious, you're like, what's your take on that have-not dynamic?
We had a joke when I was working for Colorado Medicaid that the two responses that the Colorado Hospital Association would have to any proposed reform would be number one, look at the average operating income for a hospital in Colorado. It's negative. And you'd say, okay, yes, but what about specific hospitals? Because the average is not that useful because there's a bunch of hospitals that are have like very negative operating margins and then a couple that make a lot of money. And the other one would be administrative burdens. Like you can't do this because there'll be administrative. And so whatever you proposed to change how hospitals run, you would either say, look at the average operating income or this is too administratively burdensome. And I think that kind of gets at this story. Like there's a lot of money in hospitals. If you look at it in aggregate, you say like, oh wow, these poor hospitals. But if you zoom in, you say, yeah, like if you're there's a selection bias thing. HCA owns all of the profitable hospitals and lines of business that are out there. That, means that that other people
Yeah.
own are having to operate the less profitable ones. In Indiana, all of the volume that's going to this orthopedic hospital is volume that is not cross subsidizing other unprofitable stuff at another hospital. So yeah, if you don't have to employ primary care doctors, that that's really nice. That's really great for your margins. But if then you're looking for ways and opportunities to save money, yeah, the orthopedic hospital, you're going to be like, well, maybe we could clamp down those margins a little bit.
Yeah. I have a feeling that Um, we're going to be talking about this a lot more in the coming years. I mean, as the general public moves on from insurance margins, which, as we'll talk about on earnings calls, are generally in the toilet, I feel like we careen back and forth on this pendulum between like, oh, let's look at insurance margins. Okay, now we've hammered those. Let's go back to look at hospital margins and pharma margins because those are the other key sets of profit pools in the industry. Going back to the McKinsey analysis, like they are large profit pools in the industry, and I think these sorts of numbers are going to invite questions of like, why is Parkview generating 37% margins when you've got hospitals in the state generating negative margins? There's a whole bunch of conversation around competition, generally speaking, in society right now and how we encourage that. And I'm curious to see what and how people react to that.
Speaking of competition, what about competition for compounded GLP-1s in oral format?
Ooh, that took an interesting turn last week, right? Um, I have never been as confused uh as by a company as I was by Hims and what they were doing last week. Like Thursday morning, I'm sure everybody saw this in the news, right? They announced they were releasing um their compounded version of the Wegovy pill. The news of it trickled out during Novo's earnings call. Novo stock tanked. Hims stock jumped at the time because Hims was undercutting it from a pricing perspective with compounded product on the market. Um, of course, Hims's stock bump was very short-lived because I think it was later on Thursday. I mean, this stuff happens so fast, I might get some of the timing right. The FDA came out and said, and called out him specifically and said, like, we're going to come down on this. And then on Friday, HHS said they were referring Hims to the DOJ for an investigation, um, which if you're Hims and you've got like a war room planning this out, you kind of had to know that at some point that like coming out during Novo's earnings call might prompt a reaction like this because you are basically thumbing your nose at the underlying regulatory infrastructure of how all this works. Like everybody came out, right, looking at this pill being like, I don't even know if that's actually going to work because of my limited
Snack.
understanding, right? Yeah, how it the body would actually process the medication. And it's like, what are you guys doing? Like, I just don't understand it. I'm all for competition, and the best thing that I could make sense of it with was I was reading there's a lot of short interest in Hims right now. And so there are a handful of folks who write extensively about how they don't think Hims is a viable business, for lack of putting it differently. Um, and one of the thoughts that I read in one of those pieces was essentially that Hims is betting that from a regulatory perspective, nobody's going to care and they're going to continue looking the other way. And I can almost see that playing out. Like Super Bowl week, they've got this advertisement coming out that is like riling up the populist base of we are going to provide better healthcare to the masses at lower costs. That was used to be only for wealthy folks, and now everybody can get their microdose peptides and so on and so forth. That I can like see a narrative where they're like, oh yeah, we're gonna do this and we're gonna keep winning because this like populist sentiment, people are just gonna want it enough that the regulatory schema isn't going to matter. And we've operated in this way already for the past 4 years with compounded GLP-1s that like maybe nobody's gonna care. And I don't know. Turns out people do care. Turns out it matters. And I don't know how this ends well for Hims at this point.
Yeah, one hypothesis that I have is so something else. In addition to being Novo's earnings call on Thursday, it was also the launch of Trump RX. And a
Yes.
hypothesis that I have is that when this current administration was doing some of the negotiating around most favored nation for with Novo and other drug companies, is a none of these deals are papered in any sort of like in the usual way that a deal the government would make with a private company are you'd be able to read the contract, but we don't really know. They're
Hmm.
voluntary agreements. They're at the discretion of the manufacturer. If I were a betting person, I would say that part of that deal making process was the compounding has to stop. And I think that Thursday was both a uniquely bad day to because of Novo, but also because when you log on to Trump RX, they had the non-compounded version for twice the price as Hims.
Yeah.
And that's just bad PR. That's just not smart given this
Yeah.
administration's like focus and approach to things. So yeah, I don't know what
Yeah.
Hims was thinking, but
You know who I gotta imagine is really happy with it though is Roe.
yeah,
Like generally taking the run of the same play. Hims has for whatever reason over the last few years seemingly done better than Roe. Certainly their price on the public markets well, recently perhaps hasn't been doing great, but Hims has been on a solid trajectory and seems like opened a major window for Roe and others because I would imagine Hims is going to have some legal issues moving forward. I don't know.
yeah, from every corner of the universe, it seems, from the administration, from the FDA, and
Yeah,
from Novo. It's like I,
yeah. I mean, you go back to last year, and Hims and Novo were working on partnership together, right? And then, they had their issue with that, and then they were trying to come back to the table for it. Like, I it seems like there'd be a better path forward for Hims than the
yeah,
one that they have been choosing recently, and we'll see if they can recover from here, right?
I do think that the bet, the populist bet that Hims, like, I do think that there will be some intense backlash to people not being able to get compounded GLP-1s anymore. Like, I think people will be upset. I don't know if that being upset will translate to anything,
Yeah.
but
I mean, how much is that? This is where I get a little over my skis in the topic. Like, I definitely see that playing out. And then it's like, but how much, what's the price difference like this has been one of the surprising things about the GLP-1 market compared to other markets, right? Is prices have come down so fast that it's very different today. If I remember right, I think there's my thumbs up. Um, the the Hims pill was priced at like $50 a month, which I think was $100 a month less than the Wegovy pill from Novo. Um, like that's a meaningful price difference, right? But I like, is it a big enough price difference where it's going to get negative political attention in DC because people are that upset about it? I don't know. It'll be
we'll
interesting to see
see.
how it plays out for sure.
We'll see. I think there's gonna be a lot of people complaining about it because it turns out that the main thing that Americans care about is price increases. They just want cheap stuff. Intellectual
Fair.
property be damned. So
Yep.
we'll see.
Fair. Should we go to the public
We will see.
companies?
Yeah.
So, let's run through. We'll probably run through what, five or six from last week. There was a
Yeah.
bunch of them. You want to kick us off with Molina?
Yeah.
Had
So
a Yeah, go ahead.
Molina's press release with their financials hit the wire on Thursday after market close. You and I happened to be on the phone, and I think my jaw literally dropped because they were down 30% after hours. So rewind to this point last year. Molina is giving their guidance for 2025, and they're expecting to come in at 24.50 in adjusted earnings per share, around there. Q2 comes and they say, okay, there's some headwinds. We're looking at 21.50 to 22.50. They revised that down in the third quarter to $14, and then the print for earnings per share for Q4 and the end of the year was $11.03. So three downward revisions or two downward revisions, and then they still missed. You can understand why the market was upset. A couple things that were interesting from this call. One, $2 of that underperformance was an unfavorable retroactive premium adjustment from California Medicaid. And I can't tell if I'm just being pessimistic, but the fact that a California, like a Medicaid agency, is looking for change in the SOFA to the extent that they're willing to claw back like these very large payments to their Medicaid managed care partner, it seems pretty like dire, I guess is the only way you can describe it. Is that,
Yeah.
yeah,
Yeah. Yeah. And it was, the payment was related to undocumented immigrants, right? I mean, that was who the
yes.
clawback was related to in particular. Yeah. I mean, it is hard to paint a optimistic picture about Medicaid funding right now in my mind around things like that. Being from Minnesota, there's obviously issues with the federal government and potential fraud in the state, and the federal government has said we're going to withhold payments until that is cleared up. I mean, Molina's come out and said they expect 2026 to be a trough year. On the positive side, I suppose, as they're saying, they're still expecting to be margin positive next year, even though it is a trough year. And ultimately, like all of this that's happening is a mismatch between the rates that are getting paid and underlying cost of care. And the general narrative that I hear from them is like it's 3 to 4% underfunded. And I suppose, assuming you think that comes back in a reasonable amount of time, that will allow you to go from 1% margin that you're at in 2026 in the trough year to that 3 or 4% gap should close and you should get back to 4 to 5%, right? It's just a question of like how does all of that work out over the next couple of years?
And Molina is putting the pedal to the floor on it. Like it's
Hmm.
not that they're making that bet and they're hedging by saying, and we're gonna keep the business roughly the size that it is, and we're gonna just manage our existing properties really well. They were talking about their RFP win rate for new and renewing contracts. They were talking about a Florida Medicaid contract, which they took from Centene because Centene said on their earnings call when they said that they weren't going to contest it or they weren't going after it, is that like, we couldn't figure out a way to make money on this thing.
Yep. Yep. I um I am perhaps irrationally optimistic about this longer term because I mean, everything you just said is true, right? Like that Florida thing is an issue. Um, Somehow this has to work itself out over the next couple of years. And an organization like Molina, that if you buy up those relationships right now, which is functionally what they're doing, right? Like they're saying, hey, Centene won't take this Florida business. We're going to take it for right now. And we're going to do it under the presumption that we can run our playbook and get back to some margin in this business over time. Um, Man, if that play doesn't work, I am terrified for what Medicaid looks like in this country in 5 years. Like it almost has to work de facto if Medicaid is going to survive as a market. And given where this country is headed, it seems like it's going to be an increasingly important market. And so I don't know. If you're the player that like that is your core business, there is some logic to me that like, okay, you're going to take your lumps in 2026 no matter what. Like they screwed up in 2025. They had these misses. They couldn't predict that, I suppose. But like just rip the band-aid now, take the business, presume that you're going to be able to run the play and you'll benefit from it when you do it. I don't know.
One of the interesting things from an M&A perspective they talked about is that they were going out and buying plans for 20% of revenue.
Mhm.
Um, when if you at the low point when I calculated this for Molina, they're trading at 14% of revenue. So if I'm a shareholder and you're bragging to me about getting stuff at 20% revenue, I'm a little confused. But
Fair.
yeah, no, I see it. And I think that in a world where the ship, right? Like eventually they do have to come back into equilibrium. This is what they kept on
Mhm.
talking about. Eventually rate and trend will come back into equilibrium. I think that the thing that is being underrated is the amount of stuff like the California stuff that's going to happen in the interim,
Yep.
where there's going to be really adverse, like, we're just taking this money back, and what are you going to do about it?
Yep.
And so that's,
Yep. For
I think
sure.
that's what
I
we're,
mean, there was the one analyst question kind of picking up on that sentiment of like, I think it was Michael Ha, where he said something along the lines of, we're running the analysis on what states might do as they work through Big Beautiful Bill, and it's really dire in some states. Like, are you sure that you are capturing all of that, and how confident are you in growth? And the response was basically like, listen, we're talking to all the states. We're confident that they know what they're doing, and we're planning for that. To your point, Martin, like stuff might have to change in the coming 12 months, and it'll be interesting to watch how much it does.
yeah. Well, Michael Howe was specifically asking about trimming down eligibility for Medicaid.
Yes.
And so there's a lot of
Yep.
states that have expanded Medicaid. And a thing you could do that would save a lot of money is unexpand Medicaid and have it go back to its pre-ACA roots. I think that that is one of the better scenarios for um, a Medicaid managed care plan is an unexpanded Medicaid role because
Hmm.
you know that acuity, that risk goes somewhere else. You've mostly got mothers and children. That's like a little bit more predictable, and at least there's some certainty there. The stuff like California, what California did, is really,
Yep.
I think, the thing that if I were on Molina's team, the thing that would really keep me up at night is the not just trimming the revenue by decreasing eligibility, but just randomly deciding that the amount of money that I thought I was going to get paid is not how much money I will get paid.
For sure. Yes. That is definitely the bigger issue. You
What
want to
about
do
Centene? So I think you and I both listened into Centene, but curious what your reaction was.
same story-ish, different company, right? Their stock dropped what, 10% on Friday. It's working on margin improvement across ACA, Medicare Advantage, and Medicaid. So kind of all the businesses, it's trying to right size, get back to normal. It was interesting. So Medicaid, it talked about kind of the same cost drivers it has been talking about, ABA therapy, behavioral. Um, but they did highlight some interesting examples of how they're driving progress there. They're seeing it across states. They've got task force that it sounds like they're doing all the right stuff. In the ACA business, they talked about how it was interesting. They had to take an accrual for the No Surprises Act, and that increased medical cost 1% for the year in their ACA business because providers are essentially using the dispute resolution process to throw claims at it, and it's resulting in higher costs for the same care. Centene has they shared on the call. We should actually find this lawsuit, by the way. I spent some time looking for it. I haven't found it yet. They filed a lawsuit last week with a provider in New York saying that they were extracting excess profit because of the IDN process as part of the NSA. This is one of those examples of something I think is counter to what most people expect to play out. When you see price transparency, as we have with the No Surprises Act, Centene is actually telling us, hey, this is increasing costs to the tune of 1%, which, like, rough math in 2025, right? The exchanges were 24 million people. So if you assume, um, I don't know, average premium of $500, that's 6 grand a year of premium per person. If you assume 80% of that goes to medical, that's $4,800 in medical expense per person on the exchanges. So across 24 million people, that's 117 billion of medical expense. So 1% of that is a billion plus of added cost to the system from this NSA process. If Centene's results are generally reflective, and I can't really think of why it wouldn't necessarily be reflective. It's kind of crazy to me, you know?
Yeah.
Uh, so I thought that was a really interesting data point in learning from them in the conversation. They also shared a little bit about ACA membership. Did you track along those numbers? What did you think of what's happening with effectuation rates?
Yeah, so you and I have been, as we wait for the next the effectuated enrollment data, trying to figure out exactly where stuff is going to land.
Yep.
And Centene ended the year with 5 million in ACA, and they are anticipating 3.5 million by the end of Q1. It's a pretty sizable drop off. Um, I was chatting about this with someone who works at a plan, and they shared that, they're like, well, hey, like Centene and all of the publicly traded companies, their drop offs are going to be more dramatic because of how they approach pricing this year. Like
Hmm.
they're managing for margin, and some of
Yep.
the other plans who grew a lot are maybe less interested or like less focused on managing to margin for this year. And so it's directional, but that's a
Yep.
huge drop off.
Yeah. I mean, the general narrative I've heard, like Oz at JP Morgan talking about how, listen, exchange membership hasn't dropped off. It's a sign it's stable. People are voting with their feet and staying despite us not extending these subsidies. The data is starting to show. I don't think that argument holds much water personally. Like this is a big drop off. And while there might be other ways to address it, I don't think the exchange market is particularly stable at the moment.
No. Well, I do think that Centene and the publicly traded ACA plans are the going to have the highest drop offs.
Hmm.
And so we're talking mid 30%
Hmm.
for Centene and some of the other ones. I think across the market, it's going to be in the 20s at the least.
Yeah.
So yeah,
Yep.
um, Oscar reports tomorrow. That'll be another
Ooh.
good indicator.
Ooh.
They are explicitly trying to grow,
Hmm.
and so as they often do, I feel like you can always count on Oscar to try and grow. And so
Yeah, you have to as a company of that. I mean, that has been the narrative that they
yeah,
had to do. Cigna also reported last week. I spent a little bit of time with their earnings call. It's interesting because they are like totally shifting away from being insurance company to we are PBM, specialty pharma play. Um, and the results were notably different as a result. They were up 7% after reporting earnings versus Molina and Centene, which were both down. Um, it's a pretty interesting narrative at the moment to listen to and think about where they are finding momentum. Specialty pharmacy is a key to their growth engine moving forward. They highlighted how they're doing a bunch of different strategic partnerships across the organization between Progeny and Carrot and Headspace on the insurance side of the business. Um, the other interesting data point on the insurance side of the business, which is something that we are talking about more and more in community, they announced they're launching their new copay only product called Clarity as alternative plan design. They're quoting standard numbers of like they're seeing 10% cost savings for their plans, but it is another data point about the uptake of alternative plan designs we're seeing in 2026. Given cost increases for employers, I fully expect that to keep going. Other interesting data point that they shared was that specialty now makes up 35% of their business. That's up from only 25% 3 years ago. Um, Cigna said that's both general market trends and a deliberate reorientation of the business towards that. But like that's a pretty meaningful shift in their business over the last couple of years, and I think underscores the change afoot. It was also interesting to hear analysts asking questions about like big headlines last week were the changes to PBM legislation as part of the big bill in DC, and then also the FTC settlement between with Cigna's PBM. And the analysts were like, okay, so Cigna was like, we've got clarity now, we can move forward. And some of the analyst questions are like, oh, so the GPO is moving from Switzerland back to the US. You're repatriating it as part of the agreement. Um, what's the effective tax rate impact of that on the organization? Because in Switzerland, it's like 14% or whatever. In the US, it's higher. So, like, how do I model that? And to me, that's like, it's a great example of Cigna's like, margins are going to be okay. Let's move on. Like, we've got clarity. That's great. Now DC can go focus on other stuff. PBM legislation's done. And like, you guys can model out the tax impact of flipping from a effective rate change to this. And so I'm like, yeah, that is what it is.
and I think their answer was about 1%.
Yes, that was the ultimate answer, which again,
On the tax rate, not
on the
impact
tax rate.
margin, but on the
Yes.
tax rate.
On the tax rate. Yes.
Yeah, I think that uh, I'm a PBM defender begrudgingly. The reason why you put your GPO in Switzerland to optimize tax rate is the same reason why all of the leased airplanes are leased out of Ireland is because there's like no profitable way to do it except
Yeah.
for with a favorable tax rate.
Yeah. I, I, I
It's
I
not
mean,
like it's not like shady. It's just that it's actually really sort of like you have all of this money, and if you can get a 1% tax advantage, you do it because your margins are so low. By the way, the
right.
PBM margins are 4%.
Right.
4%. Like people are so mad at PBMs and it's 4% margins.
hmm Yeah, no, I mean, I started my career working with medical device companies, and they would all talk about like, okay, are you gonna move your headquarters, Medtronic, headquartered in Minnesota? Are you gonna move your headquarters to Dublin, Ireland, because the tax rate is so much better over there? Like, you're a publicly traded company. There are things that you do because it makes more sense for your shareholders, and you go do those things. And it wasn't like, oh my God, is Medtronic like trying to hide profits and squirrel them away over in Ireland because of that? No, it's just you're changing your effective tax rate. I don't know. I don't know, Martin. Let's get
Drives
back
me
to
nuts.
US healthcare, InovAge, PACE models, one of our favorite topics. Their stock was up a lot. What's going on?
Yeah, so I really like InovAge. I really like the PACE program. They had a kind of a
Mhm.
rocky start in the public markets, and I think a lot of the challenge for them have been trying to move past that rocky start. But operationally, they are crushing it. So
Mhm.
PACE is interesting. It's kind of like a dual special needs program, but also kind of not. You're getting some money from Medicare, mostly money from Medicaid, and yeah, and so you run this integrated, you're a payvider basically, you're getting this capitated rates from those two programs, and these are highly medically frail, like a medically frail population. They don't really talk about medical loss ratios. It's just not the thing to do in PACE. They don't have to report them. But I went and backed into their MLRs, and they had a 430 basis point improvement over the prior year quarter for MLR this year, which is super impressive. They went from 82.3% to 78%.
Wow.
And their SG&A ratio improved by 260 basis points. So that they're just doing a really good job of managing a really high complex patient population. That's really impressive. Like that's a great medical loss ratio. And if you're going to be a public markets company, you I think need to. So they reported a EBITDA margin for this quarter for the first time in the 9%. It's like 9.3%. And that doesn't sound that impressive if you're talking software margins, but for highly frail
Yeah.
dual
Go
eligibles,
Yes, go talk to any capitated risk-bearing provider group and tell them that InovAge is sitting at 10% EBITDA margin in 2025 and or this last period in 2025, and it's like that is really impressive. Good for them.
yeah.
Now, what's
So
ahead? What's ahead with there's a little bit of conversation in the community around what's ahead with pace and what's happening with risk adjustment and that sort of
yeah.
stuff. And I got the impression you think it's kind of at high tide for the market. What's your take on where market heads in pace?
Yeah, so PACE, like one of the nice things if you're working with dual eligibles or you have a PACE program is that you have two revenue streams. You're getting Medicare and Medicaid dollars.
Mhm.
The flip side to that is that you have double the amount of rate risk from the government payers, right? And so
Yep.
you have for PACE, you have Medicare, like they are sensitive to the Medicare Advantage advance rate notice, not 100%, but a lot of the adjustments follow the MA advance notice. And there's a frailty multiplier. So that kind of gives you a floor of how much you're going to get. And it's better than just being an MA plan. The other thing, though, is that PACE programs start V28 this year. And one of the big things we talked about last week is with advance notice, a big part of the pushing down of that effective growth rate is a change to the V28 formula that is
Mhm.
hitting MA plans. And it basically they updated the years that serve as the basis. Part of the reason why the stock is way up is the operational stuff, but the other piece of it is that in the advance notice, they threw a bone to PACE programs and said that they're going to use a blended rate structure, some of the old V28, some of the new V28, and it's getting implemented over 3 years instead of, all in one go. So
Yep.
it's a kind of a nice moment for InovAge, who is in a similar or maybe even better position than Molina. And, they're looking around and they're saying, we can acquire these dinky little pace plans and then manage them up to, a 78% MLR.
Mhm.
I do think it's going to be hard to do that in the public markets when you have the MA rate pressure and you have state Medicaid agencies increasingly desperate for money. If you go and say to a state Medicaid agency, yeah, we're doing, 9% EBITDA margins, they'll be like, well, what about five?
Yeah. I mean, this is actually a good segue into Doximity because which I think they reported on Friday too. I listened in on that and read that one. I don't know that there's a company right now, Martin, that you can make a good case that it is better being on the public markets. And literally, an analyst towards the end of the Doximity earnings call, they were like, why are you guys a public company right now? Like, you're sitting on enough cash, you're cash flow positive. You generated 185 million of revenue in the quarter. You had 111 of that flow to adjusted EBITDA, a 60% margin. Like, why not go private? And Jeff Tangney's response was, I'm not focused on stock market performance and yada yada yada. We're operating the business, but I can tell you that investors are asking us that same question. And at some point, it's like, yeah, why? Like when the private markets are valuing seemingly significantly higher, you've got open evidence at a $12 billion valuation. You're not at that. You're a bigger company. You're growing solidly. Like I think this applies to organizations like Pace, where like or Innovation Pace, where if you can go to the private markets and you don't have to talk about things as publicly and you can acquire up businesses and grow in a more quiet manner, you can be like devoted and issue a press release that you've raised a crap load of money and grown significantly and nobody notices it versus like Humana, which is going to report earnings this week too, and everybody's going to pay attention to it, including us. I struggle to see the narrative that's like, yeah, go be a public company, you know? So Doximity is beyond that question. It was a really interesting earnings call. Their stock tanked, dropped 25% after they reported earnings. The numbers for the quarter were actually good, but they signaled weakness in pharma clients and their advertising spend due to some of the regulatory uncertainty in the space. I didn't hear, I mean, obviously that's going to make people skittish, right? Like they were worried about it. Clearly, the open evidence momentum in the market right now weighs on it a little bit. Tangney kind of in a veiled way referred to it as he said at one point, he's like, nobody is close to anything near super intelligence in the market, which is open evidence is big play at the moment and what they've been talking about from a funding perspective. Um, but beyond that, I actually hear a lot of momentum in what Doximity is doing. They were talking about the new adoption they're having in AI products. I think they said 100 hospitals are using it, and they got something like 300,000 quarterly active docs on it, which I don't know, but that seems impressive to me, Martin. Like, I'd be pretty happy with those sorts of numbers in Doximity's case. And they're talking about commercializing it in 2026. And I'm like, you know, I get that open evidence has taken the momentum. We've talked a lot about provider attention and who's going to win that. It doesn't seem like Doximity is losing, although it does seem like they're losing momentum on the public markets. And that's where it's like, why not go private if there's somebody out there to that's got the capital to do it? And I think that's probably the interesting question is like, where are the pools of capital today and who actually has the dry powder to take works like that private? And what is then the exit opportunity in a private equity market that is challenging and a strategic market that's also challenging? I don't know. I don't know.
Yeah, how many leveraged buyout models do you think analysts have put together for Doximity? Like that's so much free cash flow.
So much.
You could load that thing up with so much debt.
Yes, a lot. and not be worried about it like you are with other companies, right? Which is,
Yeah, I like I an interesting last week Anthropic released this piece of software that looked like it could replace a bunch of legal software. It basically caused a huge meltdown in the markets. SaaS companies all tanked, and uh, because the thing that investors like is stable recurring cash flows, and so that's nice. But you're looking at advertising contracts, and that is not easily replaceable by an Anthropic vibe coded app and more regulated. And yeah, I would love to be pitching them on a leverage buyout right now. Like, here's what we can do. Last one for the day, and then I think we got to move on or call it a day. But DaVita reported earnings, my
Yep.
former employer. I always love seeing what's going on with them. So a couple quick hits from them. They so mortality and mistreatments are still high post COVID, and that's something that everyone's dealing with, and they're working on it, but they don't think
Hmm.
that will be we'll see any relief there for 27 or 28. Something that's interesting to me is they are penciling in 40 million in headwinds from the expiration of the advanced premium tax credits. And so I thought this was funny. I don't know if other people thought it was as funny as I thought it was, but okay, so we're not doing the advanced premium tax credits. The average advanced premium credits like $500, and from the subsidy from the government. So for a year, that's like 6 grand for one of these patients who like DaVita patients. So it's a $40 million headwind for DaVita, but it's also the average price for a dialysis patient is like $80,000 for Medicare.
Mhm.
So they're predicting these patients are going to go from ACA to Medicare, which is financed by us as taxpayers. And so instead of paying $6,000 a year in subsidies, we're now going to pay $80,000 a year. So that's a bad trade for DaVita, but also for you and me. I'm so mad. And so you're like, okay, who wins here? And it's like, oh, the ACA plan who gets to move $80,000 of dialysis costs off their books. Good for them. What a win.
Yep, that sounds nice.
Oh
I,
man.
as you were as you were talking, I was looking up their stock price. They've done well over the last month. They're up 25% almost. Uh, I had no idea DaVita is only a $10 billion company. I would have
Yeah.
guessed it was like 100 billion. I thought like in my head it's like, Intuitive Surgical, which I wrote about in the newsletter, is 180 billion in market cap. I am shocked DaVita is only a $10 billion company.
Well, so this gets actually is a perfect segue to my next point, which is they're limited right now because most of their business is the in-center dialysis business. And that is a tough business to be in. I mean, it is like imagine running a retail store or a Starbucks franchise system, but super highly regulated, super expensive SG&A costs. And the reimbursement from the government is not that generous. And so one of the things that they've been working on is this thing called integrated kidney care,
Mhm.
value-based care in for kidney contracts. And they call that IKC, and for the first quarter, they were reported positive operating income, $22 million for IKC. And they have been working on this for 4 years, is when they started making these investments in IKC. And they said, like, it'll probably be 4 or 5 years before we turn a profit. And they turned a profit, which is terrific. Tim Fitzpatrick, our friend from Signals, had a great write up on this. I shared it in the community, but he talked a little bit about the rationale behind their acquisition of Alara. So they made a strategic investment along with a private equity company in this home care company called Alara, and the revenue opportunity is just so much better on in-home dialysis and integrated
Crazy.
kidney care. It's like, yeah, it's meaningfully better. It goes from like 300 to $500 or whatever per treatment. And
Hmm.
so they're working on it. I mean, DaVita has, I think there's a bunch of smart, ambitious people trying to figure out how to do that in a responsible way. The corporate strategy and corp dev teams, I think, got disciplined a little bit after a kind of disastrous healthcare partners acquisition and divestment. But yeah, they would like to be a bigger company, and this is an opportunity for them to do it. IKC, it's like it's really promising to see them post operating
Mhm.
income profit on that.
Yeah.
And so I'm really excited to see where that goes
Hmm.
and how that performs in the coming months. We sort of have to wait another year because of the way that value-based care contracts work. Like we will get a IKC
Yeah.
update at the next quarter, but it's going to be meaningless
Yeah.
because
You need to wait for it to flow through. Yeah, yeah, for sure.
yeah.
The other interesting part of that, and then I'll let you go, unless you have any other thoughts on it. I am curious to see. It feels like a bubbling up trend that we are talking more and more about. Hey, a strategic is coming in with private equity to make investment purchase of an asset as a way of financing and de-risking for both parties, right? From the strategic side, you get access to capital that you don't want to allocate fully yourself. From the financial side, you get a strategic partner who theoretically is aligned and should make for a good natural exit, assuming things go well. I'm curious to see how activity in that space percolates over time. I could imagine a world where this is a going trend for big deals. Obviously, there's risks with these sorts of deals, right? If they go sideways, that becomes a challenge because you're essentially locked in on both sides. But in a market where it's tough to finance big deals, and there's not a lot of dollars on the private markets, and the public markets are challenged, and strategics are facing their issues. It strikes me as a way to get deals done.
And if you're building if you're building a vertically integrated payvider
Hmm.
deal, having a home care asset like Alara is amazing from a margin perspective.
For sure.
Assuming that they are generating profits, and I believe, even when they were at their most distressed, they were generating profits. You stick that into your value-based care system, and
Yeah,
you go back to the bright health slide, which we love to talk about.
for sure.
It is a smart move.
Yeah. The issue with balance sheet issues is not actually a P&L issue necessarily. It can be, but it's an assumption issue from the original underwriting case, right? Like, I don't know what Alara's free cash flows were when they did that distressed debt recap and whatever it was, 22, 23. But like, you can still have free cash flows. It's just an issue if you're not meeting your debt obligation because you didn't grow enough or you contracted some in a market. And those things are uh,
Yeah.
numbers that you need that we don't have access to public necessarily.
So this seems like it was a win across the board,
For
and
sure.
I'm excited to see what else DaVita has in the pipeline because I've heard some rumors that they've made some other strategic deals recently. So we'll be
That'd be cool to watch. Yep,
yeah. All right, Kevin, thanks so much for your time.
for sure. See you, Martin.